Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course, help to make it actionable, understandable, and clear. What a week, what a show. Batten down the hatches, Dallasites. A winter storm is coming our way. We've got a great show. I'll give you a little bit of weather advice because that's just how nimble we are on our feet over here at the Market Update. But we're going to look at some excellent Peter Mallouck data, one of our favorites, as a way to hype us up to continue on our investing journey using index funds. We then look at some a great Wall Street Journal article that talks about how young traders are using fake money. And then in closing, it's not a great article, but it's a great point. There's a Dave Ramsey interview where he talks about how rich folks actually aren't that sophisticated with investing. I think it's an important point that bears repeating. Let's go to the top. Let's talk a little weather. As you know, listener, we're going to keep our costs low, investing simple, time horizon long, but what about the weather? We'll keep the faucets dripping, open the cabinet doors, and make sure that hot air is getting in there, and then get the key to turn off the water to your house. If you're a home dweller, if the pipes burst, get that key ready. Now that we've got that out of the way, let's talk some Peter Mallouck data. Mr. Mallouck just had some excellent charts that I want to bring to our attention. He started first with the risk-return trade-off. Doubtless, you've heard it said, I want to achieve high returns, but I don't want a lot of volatility. You ever heard that? Volatility measuring the amount of change in the value of the asset. The returns being the percentage returns each year that investment goes up or down. Mr. Mallouck highlighted three different asset classes. One, U.S. cash, 3-month treasury bills, 10-year treasury bonds, and then U.S. stocks. And then looked at the annualized volatility, annualized total returns, and the chart. This may be no surprise to you, but it showed U.S. stocks represented by the S&P 500, annual returns from 1928 to present, about 10%. Volatility, about 20%. Okay, so U.S. stocks return 10%, volatility 20%. As you move down, U.S. bonds, only about 8% volatility, about 5% returns. Cash, 3-month T-bills, which is more volatile than I thought. It looks like it's about 3% annualized volatility, which I thought it'd be even less. And then returns, a little less than 4%. Great reminder, no free lunch, and also anyone that packages a financial product for you, and they're out there, they have to do some form of financial engineering that is not to your benefit. So I get as a registered investment advisor, I get a lot of advertisements that folks want me to send to you or send to my clients. And they say, hey, get all the upside of the market without the downside. You ever heard that? Get all that upside, but limit the downside. Well, just think back to this chart. Wait just a second. That volatility is the secret sauce. I don't want you to take that away. Because how else am I going to get my returns? Well, they've got to do some funny math, some engineering that usually involves a bunch of fees and complexity it's German engineering. Something can break. Whatever financial product they build, it can break. So don't fear the volatility. Recognize that it's the reason why you're getting those good returns. If there was no volatility in the S&P 500 and it was delivering 10% a year, there'd be a ton of money attracted to that asset class and the returns would go down. Let us never forget, it was Bernie Madoff, the Ponzi schemer himself, who raised billions of dollars promising 8% fixed, no volatility. Can you imagine that? Someone comes to you and says, I'm going to pay you 8% fixed a year, and it'll just compound or be a coupon. No volatility. Now, wait just a second. If you go back to this handy-dandy chart, you might be thinking, now, wait a second. You're promising me higher returns than U.S. bonds or U.S. cash and lower volatility? I think having this chart in our brains could hopefully cover a multitude of financial sins. And I bet there are a lot of folks who invested in Mr. Madoff's program that wish they had gone back to this and said, hey, the math isn't mathing. So don't forget volatility. It actually is the secret sauce to ensuring you get your returns. And then another reason, I've talked about this, I realize, but international diversification can help. The returns 25 These past year returns, emerging market stocks up 42%, European stocks up 39%, U.S. stocks up 19%. And actually, this is taking it from January 18, 25 to January 18 of 26. So a year, but wow, finally happened, didn't it? And then I threw up another chart. It just talks about how, hey, for the last 15 years, U.S. stocks have outperformed. And then there was a international outperforming from maybe 2000 to 2010, and then U.S. stocks outperformed from 1990 to 2000, and then international outperformed from 85 to 92, and then back and forth and back and forth, back and forth. So the U.S. has had the longest, most pronounced outperformance. That may continue, but it sure is nice having some diversification. Keeps us on the straight and narrow, which is really the goal. Time horizon long. Great reminder on the dangers of doing nothing. So oftentimes, and this is totally understandable, it's human nature. Folks will come into my office, they're here, so I know they're ready to do something, but I realize after about 20 minutes or so, sometimes longer, they're going to do some significant hurdles to getting them to invest. One of the, and I feel those same hurdles too. There's all the headline risk, and the stock market, is it maybe they think it's phony, and I can understand that. There's this chart, 1996 to present. Inflation-adjusted growth of $1 over the last 30 years. Let's do a little definitional work. Meaning after inflation, why does inflation occur? You guys may know this. It's a monetary phenomenon. More dollars chasing fewer goods and services. So as more money enters the system, so $1 in 1996 was worth 48 cents in December of 2025. I'll say that again. $1 purchasing power in 1996 is just 48 cents. However, S&P 500 total return, $18.57. It's after inflation. So I show this to someone, and this usually cures it pretty quick. And they go, wow, yeah, it's more expensive to wait in cash than it is to try to guess the market's movements. It's more expensive. So we got to remind that to our own brains. And then the last one, this is the January 1976 to present increase over the last 50 years. It says inflation is up 6 times, CPI. The dividends on the S&P 500 is up 21 times, and the total return, that's the increase in the value of the S&P 500 plus the dividends, is up 292 times in the S&P 500. So you just look at, so those two, for the person, and it can be me, it can be us, who's just scared of that sitting in cash, those last 2 data points just say, the only thing scarier than sitting in cash, you really shouldn't be scared. You should just be more scared of sitting in cash. You should look at that and say, the opportunity cost is scarier. So be willing to get in there, mix it up. You can read about maybe the man in the arena, Teddy Roosevelt quote. I can inspire you to get in the market. Just do it. And then I thought a fascinating article, Wall Street Journal by Mr. Dalvin Brown, headlined, How Young Traders Use Fake Money to Practice for the Real Thing. Subheadline, Stock Market Simulators Let People Learn and Experiment as well as Try Out Risky Bets. This caught my eye for a number of reasons. But number one, because oftentimes the question is asked to me, Robert, how do I get my kids involved in investing? I hear that. Oftentimes a parent, a grandparent is thinking generationally, how do I get my kid to even want to engage in this? And I'll be the first to admit, if the very first time you hear about investing, you get a speech from me about index funds, you may be a little bored. And you may think this investing thing isn't for me. So I'm open and okay with someone deciding they want to try all the complicated, scary investing programs prior to going to the land of Canaan, where we invest in index funds. So in this article, it talks about the dangers, and I appreciated that warning, of these simulated investing platforms. What'll happen, and the article gives a story of a young person who was rewarded. Hey, whoever, usually it's in a classroom setting, whoever has the best return over this month wins the award. And so someone was able to invest in options for GameStop, and they got 2,000% in a month. So they won. What happened, and this is Robert Reitz is his name. This was high school investing competition in 2021. He said it kind of encouraged very, very risky investment decisions, said Reitz. My intro to investing was basically gambling. There you go. Truth. So that's the danger in these programs is you might get lucky. That can oftentimes be the worst thing that ever happens to someone is they make a bunch of money getting lucky. Because of course they digest that as, oh, it wasn't luck. That was just right place, right time, right instincts, right intellect. Of course it would happen to me. Of course. And we begin to think too highly of our ability to predict markets. So I like a guided approach to this. I want someone to actually try this. If someone wants to, I'd like to fake money, think, hey, do the fake money. Go ahead, knock it out. You'll probably do it and realize, oh, this takes a bunch of time, it's super stressful, and I'm not going to beat the index. However, you may beat the index. Okay, if you walk into a casino and play the roulette wheel, you may leave a winner. However, if you keep playing that game over the course of your life, you'll most certainly be a loser. Same dynamic is afoot in investing. You might make that big bet that Mr. Robert Reitz made in 2021 and be up 2,000% a month over your lifetime. No bueno. For my listeners in España, no bueno. This will eventually catch up to you and it will not be good. So I like a guided approach, meaning, hey, daughter, son, who wants to do this? Knock yourself out. Report back to me in a month. Let's hear about it. Or 6 weeks. Let's hear about it. Or whatever. Or maybe in 3 months. And all the while, I hope you have some charts ready where you can show the aspiring investor, hey, let's say you beat the market, did great. Let me show you how often people can do that over the course of a long period of time. Keep going, fake money. And I think it's that experiential learning. As the great Charlotte Mason says, all education is self-education. We must do our own mind work, she says. We must do our own mind work. So you can't just matrix it. You can't just, put someone, upload investing, upload Bogle, upload all your favorite podcast and expect that, no, experiential. For most folks, it's got to be experiential. I got to touch the pot. It's got to burn me. I got to learn a lesson. I got to get burned again and again and again. That's, I understand why that's scary for a parent or a grandparent or even for yourself. Look, this is for ourselves. Maybe you yourself or me. I've got a strategy I want to trade. I'm all for it. I like visibility, guardrails, and doing something like this in community. So maybe you find a friend. Hey, can I just share my results with you? I'm going to do this thing, whatever. Don't do it in isolation. Don't start trading real money in isolation. All the psychological foibles can come into play, and it can be very, very expensive. We want to make your education inexpensive, keep our cost low. One of the ways to do that is, use one of these fake money trading platforms and give it a go. Give it a go. I, of course, what do? I go back to the Spiva report, SPIVA. If you're on your Google machine, just type in Spiva report results, see what the latest are. They don't really change, but it shows how often the professional stock picking class fails to beat the index over 10, 15, 20-year periods. It's all of them, basically. It's 95% or something, 90%. So that's enough for me. However, I can appreciate why, hey, we all think we can join the PGA Tour. And look, you might be the one. I doubt it, but you might be the one. And then in closing, Dave Ramsey, one of our favorites. We don't always agree with Mr. Ramsey in the area of investing, but in this instance, I think he's just spot on. This is an article I don't really want you to read it. It's kind of one of these garbage articles, but it's basically I'll say it. It's Janine Mancini wrote it. It's Yahoo Finance. And here's a disclosure. They may earn a commission or revenue on some of the items through the links below. So it's not quality literature. It is twaddle, as Miss Mason would say, twaddle. However, I've sorted through the twaddle for you, and we'll try to elevate this to more of a living work in the personal finance space. Dave Ramsey says the rich aren't sophisticated with investing. They're just very primitive and buy land. They got dirt, man. That's it. And this article talks about how Ramsey has a core idea, which I love. Invest with clarity, not with complexity. Check this quote out. There's something that happens when you get money, Ramsey said. You think that everybody that has money is sophisticated about their investing. What I figured out is almost no one is. Ding, ding, ding. Instead, he said, wealthy people tend to be very primitive. That wasn't a put down, it was a strategy. And here it is. Ramsey says, a lot of people I talk to are farmers, Ramsey explained. You know what they buy? Lots of land. They got dirt, man. That's it, just dirt. So Ramsey says this, put money in stuff you love and you understand. Don't put money in stuff because it sounds sophisticated, because you're getting ready to lose your bottom. I just think Ramsey's right on, and I just couldn't agree more about his analysis that most folks think there's this curtain, there's this Wizard of Oz moment where maybe we're like Dorothy and, hey, we get a little money, but we want to meet Oz. We want to see the great Oz, and the great Oz is going to teach us and help us how to multiply that money that we got. Maybe we built a business, or we have a successful career. We were just disciplined in our savings, and so we accumulated some capital. So we're going to Oz. We're going to meet with the wizard, the wonderful Wizard of Oz. And you know the punchline. Who is Oz? He's just a man with some little controls back there, and it's puffing smoke, and it's not real. It's not real. However, this is the great difficulty that anybody can have, but particularly the wealthy. In almost every other arena, the wealthy are given a card, they can go past the velvet rope, and they get superior products. Okay, this is true in cars to a point. I think cars may be a bad example. Toyota Corolla may be the premier vehicle of all vehicles, and yet it's lower cost. But in investing, it's the inverse. And so what I see is, hey, maybe you make $100 million, you sell your company. Where do you invest? You're probably going to be investing in inferior products to the person that just does index funds, almost without exception. That's a difficult thing to believe, but it is true. Math is the math. There's not a secret alchemy that allows you to turn stones into gold, and there's not a secret alchemy that allows you to create returns where there are not returns. The great Jack Bogle, founder of the Vanguard Group, his foundational belief was that investors just need to ensure they get the return the market provides. That is an excellent result. And I agree completely. There's great danger in thinking, oh, wow, if I could just get beyond this curtain and invest how they invest. So just remember, if you are on that yellow brick road, turn around, keep your costs low, your investing simple, and your time horizon long, because that is what's going to give you the best shot on your investing journey. Stay warm.